Well, a warm welcome everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial, which is a locally owned financial planning firm here in Brisbane. Today we have Paul Xiradis from Ausbil Investment Management. Paul's investment journey began in 1979. With over 4 decades of experience, he's become a prominent figure in the industry. In 1997, Paul co-founded Ausbil, an Australian equities house. Under his leadership, Ausbil has grown to one of Australia's leading investment managers, offering both Australian and global equity funds. Today, Paul holds multiple key positions in Ausbil. He's the Executive Chairman, Chief Investment Officer and Head of Equities. His responsibilities include portfolio construction and strategy, as well as managing the equities team. Paul's experience and leadership has been instrumental in building Ausbil into a multi-billion-dollar investment manager. His role encompasses investment strategy, portfolio construction, and contributing to the investment management of Ausbil funds. Paul is also a member and chairman of Ausbil's Portfolio Construction Committee, where he continues to shape the future of investment management. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information, which is general in nature, meaning it doesn't take into account your own objectives, financial situations or needs. So it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Please also refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website. Paul, as a fund manager specialising in Australian equities, being the active equity fund, can you talk us through Ausbil Investment Management's history and investment philosophy?
All right. Ausbil's been around for a number of years now. I think we're in our 28th year, so it's been a long-term investment within Ausbil. I co-founded Ausbil at that time, some 28 years ago. The investment process has not changed in all those years, and that's been part of the reason why we've been fairly consistent in delivering the performance that we have delivered over those years. We're a little bit different to most managers. We openly say that we're top-down, bottom-up, which does mean that we do have internal capabilities from a bigger picture point of view. We have our own economists, which is a little bit different. Most fund managers try to hide their economists when they in the investment process, but no, it's front and forward for us. But it just gives us a framework to think about when we're looking at companies. But the other side of our process is really that bottom-up process, which is critical. We have a full complement, a big team which looks at all the companies in Australia. We certainly do model about 250 companies, which is quite substantial, and we do model every company in the ASX 200. So it's a combination of top-down, bottom-up. It helps us frame, as we said, the opportunity set as we see it. But at the end of the day, it really is it's the recommendations that come from the analysts, from the bottom-up work they do in analysing those particular companies.
Okay. So how do you assess risk when you make the investment decision?
Yeah, there's a number of risks that you always got to take into account, and clearly that's what we do. Clearly the bigger picture is one of those. You're talking about growth, domestic growth, global growth, interest rates, currency risk, and all those other factors, and that's important to have a framework to understand that. But then there's obviously the individual company risk as well. You need to have a pretty good understanding of the company, understanding the profile that it has, understanding the risks that it has, understanding its competitors, understanding how it sits in the marketplace, and what their competitive advantages are. So these are all different risks which you need to assess. And at the end of the day, we undertake that, then we look at the company and determine if we like it or dislike it for a number of different reasons. Or maybe we don't like it for now because we think the risk is too high here, or we think that perhaps further down the track there may be an opportunity. So risk is a bit of a moving feast,
sure.
But certainly all those factors come into account when we actually determine the risk factors. But at the end of the day, we need to make a recommendation internally, so it's clear and it's well understood. Our analysts do come up with recommendations. It's either a buy or a sell. There's no in between. You can't sit in the middle. But we do. But you've got to grade your strength of your call. So if it's an overweight 3, that's our strongest call. An overweight 1 is an overweight call. Overweight 2 is the second highest.
Okay.
And then you go down the scale.
So at the time of recording, we've got Trump on global tariffs.
Yeah, we have.
So what are the opportunities and risks you see in the marketplace at the moment?
Well, certainly it's creating a lot of opportunities as we see it now. I mean, there's risks I think are known in the marketplace, but they're still not fully quantifiable, and we still don't know what the end result will be. So we do come up with a range of scenarios of what we think it's likely to be over the next period. We have an optimistic or a probability of it being quietly severely damaging. We have one which we give a 15% test to or assign to. We also have a view that 20% could actually turn out to be very, very positive, but that's the upside. But our base view, which is 65% probability, we think it will actually recover and it'll work itself through as far as all these tariffs are concerned. We think it's all been designed to bring countries to the table, to actually force them to enter into bilateral agreements and also strengthen the relationship. But also, obviously, to the benefit of the US is obviously the end goal, and we have assigned responsibility, outcomes based on that base case. So all in all, we are a bit more optimistic than the market may anticipate. Clearly the market was quite fearful. That really indicated or suggested that the market could actually fall quite dramatically because of the underlying economy. We don't believe that to be the case. We think that the end result it will be resolved. There will be some tariffs introduced. It will be such where it won't be too inflationary. We also do believe interest rates will be cut. So the backdrop is actually not too bad at the moment.
Okay. So what is Ausbil's investment management's greatest strengths as a fund manager?
Look, I think it's been proven time and time again, really. I mean, obviously consistency is one of those things, and what is consistency is obviously applying, your process, day in, day out without deviation. That's what we do. But I think our real strength is our top-down approach, because clearly, in times of uncertainty, the market doesn't know how to react, right? It panics. And I think that, by having, a top-down view, in the sense of having an internal economist and having experienced fund managers debating it, coming up with a view, really actually puts you in a stronger footing. We have seen that in periods of adversity. We have seen it when there's been major downturns, where we've actually worked through those processes and actually given us conviction to invest, clearly against a set of parameters and also against, some guardrails as we put it. So that means you're not inactive, you're not frozen. You're actually taking, positive steps to actually take advantage of the opportunities. So I think that to answer the question in short, it really is our process top down, but then applying our bottom up consistency.
Sure. Can you talk us through a time when you've turned a period of poor performance and returned into an opportunity and turned the fund around?
Yeah, look, active managers do have a period of underperformance, and that is part and parcel. Sometimes it is factors which are external, some because of your own making, and some because of you misread a couple of things. They are always there, and you obviously try to eliminate those as much as possible. But there tends to be, when we think, the time when we have underperformed tends to be at a turning point where things are actually, from an economic perspective, have been overplayed or been overstudied in the sense of on the negative side, and it just creates opportunities. So that's the time when we really actually make a lot of money by having conviction and doing some extra work about the bigger picture, then investing accordingly. So we may have a period of underperformance because the market may be concerned about factors. We may not be totally positioned for that because we tend to be positioned for a continuum of things going forward, and when that's abruptly hit or changed, that creates an opportunity. But then we look at it in a fair bit of detail, reassess it. Maybe we don't change, maybe we amplify, and maybe we actually do reposition the portfolio. But that's the key. You need to have an open mind. You need to assess the opportunities, and you need to actually assess the environment that you're in today and what changes may occur in the next 12 months, and then position the portfolio accordingly.
Okay. So what types of investments have you made in the portfolio recently?
Yeah, look, we've made a number of investments in the sense of rejigging, and if you like, and actually finessing part of our exposures. In the healthcare sector, for instance, just recently, we've been reducing our exposure in ResMed. ResMed's been a great position for us, and again, that's a pretty good example. In the past, that was a stock which was hit very hard. 18 months, 2 years ago, it was sold down very aggressively. There was big concerns about the drug, about the weight loss drug and what that would mean as far as their business was concerned. We think that was overplayed. We actually reinvested into that particular company at a low point and made a fair bit of money as a consequence of that. Now that has played out as far as we're concerned. And then we look at the rest of the healthcare sector and saying, well, there's other opportunities right now, perhaps a little bit better. So we've been switching out of ResMed and we've actually entered into Carty for the first time in many years. And part of the reason for that is that it did get sold down in recent times. It is what they call a high PE stock. And the reason why it's a high PE stock, it's a unique business that actually grows very strongly and invests in this business, and it has a quite a unique product. But it did actually get sold down a bit. But what's exciting us is for the first time in about 12 or 13 years, it's introducing an enhanced product to its offering, or advancement on its offering, which is quite universal in the sense of it being far better in reception and other things. So we think there's some considerable upside. So we've been switching out of ResMed into Carty as an example. For the first time in many years, we've been investing in property trust. We haven't been all that overweight in property trust. We've only been in Goodman Group, really over the years, which has been consistent. But we do believe that interest rates are going to come back. We think there is an underbuild in residential property. We're trying to play those two factors, and also we do believe that rental levels have come back, which have now sustained, actually likely to rise, and cap rates are likely to harden, so valuations are increasing. So we have established a new position in Mirvac, because that actually looks to us to be a nice way to play what I've just described.
So how do you stay up to date in the financial markets with all the information that's going around?
Yeah, look, it's a 24/7 job, right? It's never ending. We put in long hours, the whole team, but obviously we rely on each other as well. We can't cover everything, so we do have it's a team effort. How we communicate in them every day is we as a whole team, and there's 35 of us, have a morning meeting which I chair. If not, my fellow PMs would do so. But it really is just bringing everyone up to date about their knowledge base, about what they've learned the day before, what's happening in the marketplace, what does it mean, what happened overnight, does that have any ramifications to the portfolio, and also their recommendations. So it's just an ongoing issue that we need to be addressing. But the other thing is you need to have passion, right? And that's the other thing that I have within the organisation. I have everyone which are really passionate about markets, really want to be focused on markets, and really want to actually strive to win and actually do the right thing by our clients. So you need to have the actual desire, the passion, and also the ability to do it, and also have structure around it. That's how we do that.
Okay. So what makes a good portfolio manager?
I think you've got to be open-minded, right, and not be too wedded to a particular story or view, because that can be an undoing of people, an undoing of markets, undoing of portfolio positioning. I think that the challenge with all of us is to have that open mind, and you don't like being proven wrong. But the thing is, what you need to be doing is always testing your thesis, and also testing your logic, and making sure that it's still accurate and right. And then if it's proven to be wrong, or if it's proven not to be right, or it's not quite what you expect, you've got to have the ability. You've got to be flexible enough to actually make that change, and make that change quite decisively. So you've got a good portfolio manager needs to be open-minded about things. Obviously, undertake research, but when things change or when an opportunity does shift, you need to also shift with that.
Okay. So Paul, we've covered a lot of ground this morning. Is there anything else you'd like to add before we finish?
No, you're right. We've covered a lot. I think they're very good questions, and it really gives an insight about how we're thinking. So thank you for this morning.
Appreciate your time. Thank you.
Thank you.
If you'd like to talk to Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out and contact me via our website, or give our office a call to schedule an appointment. Thanks very much for your time, Paul. I really enjoyed our conversation and getting an update on what's happening at Ausbil.